Good morning. I have to say, this year I'm happy to have a musical introduction. I'm happy to see more live people than cardboard cutouts this year, as opposed to last year. It's delightful to be back in the land of people. I'm delighted to be here with Singh this morning. As background, AJ started investing more than 15 years ago, or entered the industry more than 15 years ago, as he told me, not by design, but by default. But that means that he was one of the early ones to enter the realm of sustainability and sustainable investing at firms such as Goldman Sachs and Jefferies, and then was a fund manager looking at ESG. He consulted for institutional clients on how to get to net zero and to meet the Paris goals. He joined Quintet a year ago as Executive Director of ESG and Sustainable Investing. So most of his career in sustainable investing has occurred across public and private markets. AJ. So before we talk about the P in the profitability, ideology, and expectations part of our talk, let's start with when and why, which really will define the expectations as well as the ideology aspect of our discussion. When did you see the demand for profitable investments that were quote-unquote socially responsible, if you will, start to ratchet up, and why would you say that happened?
Good morning. Thank you for the introduction, and thank you for having me. So I think there's been lots of factors that have been at play since I've been in the industry, and one that always comes up is how the wealth generation of the millennials, as they become from 25 years old, as they've got older to 35 to 40, the wealth generation economic curve of them has increased, and it's become more important for them as their wealth generation has increased. They also become more in charge of managing the wealth of their families, and we found that millennials have a high affiliation with sustainable investing, maybe more so than baby boomers, because they want to look after the world that they're going to inherit. There's been a few other things that we think are driving is consumer behavior. We think is hugely important and changing. Clean energy and electric mobility is becoming very paramount. For example, electric vehicles in this world are only 3 to 9% of the population, depending on what country you look at. And Bloomberg estimates that in 20 years that's going to be 80%. So that there is huge demographic shift going on, and consumer behavior patterns that are changing. Company behavior as well. The previous speaker mentioned about how Europe is doubling down on its efforts to wean off, oil and gas from Russia, and that will change consumer behavior. The capex will go towards more renewable energies, but it will take time as the industry evolves. And obviously, we've seen the weather temperatures around the world, and the latest IPCC report show that the window is closing for us to actually do something. So there's been lots of forces at play, from demographics to geographics as well. In the US now, you've got Gary Gensler, the head of SEC, who's making corporates talk about climate disclosures in company reports, and how that's going to look like. But I think I've been most excited in my entire career about sustainable investing probably last year the most. And that was because we had something which was very interesting, which was, without going into the details of it, is that you had regulation called SFDR, which meant that if you're an asset manager in Europe, you have to label your fund either brown, which means it's got nothing to do with sustainability, green, there's some sustainability elements, and dark green, which is very much looking at ESG and sustainability. And that classification system is a game changer, because it means asset owners who are pension funds, which I think are the biggest guns on the street and own the most amount of assets, they can drive asset flows towards more green and ESG funds, because they don't want reputational risk. They don't want to be seen to be owning 80, 90% in brown funds. Eventually, they want to have the perception that they are investing more and more into what you would say green and dark green funds. And as that perception evolves and the asset flows move in that direction, I think whether you believe in sustainable investing or not, that will drive momentum, that will drive asset appreciation in the markets that are very much going into sustainability. So just to sum up, I think there are many things here at play. From regulation to demographics to wealth creation being distributed, and millennials becoming more older as well. And for us, that's why at Quintet, our core DPM proposition, which is our discretionary core portfolio, is by default sustainable. So if you are a client of ours and you invest in us, by default, you will be put into a sustainable portfolio, and you almost have to opt out if that's something that you don't want to do, because it's becoming so mainstream and so important for everyone.
Terrific. Let's talk about profitability. At Vitalbriefing, we see all sorts of conflicting information here. We see a lot of misleading information in this area. We all know, as Pierre talked about earlier and you mentioned, we've all seen greenwashing that continues to be a fundamental characteristic of the industry. It's probably not too strong to say that. And we see corporates deliberately or unwittingly labeling funds and investments as responsible. And when you dig down, maybe they're not so much or not at all. Convince me that I'm going to make as much money or more money as a responsible investor as I would if I applied other more mercenary, if you will, criteria to my investment decisions.
Sure. So I think, if you look at sustainable indices versus conventional indices, sustainable indices or funds have generally outperformed the conventional counterparts for the last 6 years. This year they're underperforming, but that doesn't, 1 year or 6 months doesn't make a trend. So sustainable investments have outperformed their conventional counterparts, and a lot of that is to do with looking at why are these companies producing products and services and have got better governance. So what do I mean by that is that, as you kind of look through companies that have targets towards net zero, you end up looking through, they have to, as a result, look through their supply chains, their scope 1, scope 2, scope 3 emissions, and that finds inefficiencies, that finds ways that they can improve their bottom line and profitability. And as a result, it goes through the entire value chain of the companies with a fine-tooth comb. So I think, when you're looking at ESG companies that are leaders in the space, you're going to end up finding companies that have got good quality bias, and that good quality bias reflects in the asset price performance, which is, as a result, if you have a fund or an indice full of ESG leaders or a sustainable fund, has that alpha and ends up outperforming over conventional indices, and you've seen that over the last 6 years.
Finally, the newer generation of investors that you referred to, plus institutional investors such as pension funds, tend to be more engaged in monitoring their investments than more traditional investors or investors in the past. How does that impact profitability? Why is it better to engage with companies rather than simply to exclude them if they don't meet your ESG criteria?
Yeah, that's a really good question, and there is a lot of academic evidence out there and meta-studies that have shown that if you engage with companies, you get roughly on average a 7% outperformance of the stock over the following year. And that's because there's evidence to show that face-to-face engagement, it can be very powerful. And collective engagement. So we believe in engagement collectively with other shareholders because it has more leverage. So if a lot of the community is asking you to change something, the more higher chance that the companies will listen. For example, shareholder resolutions in support of climate change through proxy voting, which is a form of engagement or active ownership, in the US tripled between 2020 and 2021, especially for oil majors. For example, at Quintet, when we're doing proxy voting, we've supported 93% of environmental shareholder proposals in 2021, and that's roughly double the industry average. And also, just one final comment on engagement versus exclusion. There is more academic evidence to show that if you exclude, generally speaking, the stock selling pressure has to be around 25% of investors have to actually collectively sell to have any material impact on the cost of capital of that company. And that's very, that's a big number. And it takes around roughly 20 days only for the stock to kind of mean revert back to where it was before. So excluding companies and selling companies out of your portfolio, there is academic evidence to prove that one that requires a big herd selling, and it doesn't last very long. Whereas engagement, like I said, can produce really a decent amount of alpha over the following year. So we definitely think that it's better to engage than exclude in your portfolios.
Let me throw a curveball at you, AJ. When we come back here in 5 years, let's envision a world where the Ukraine war is settled, things are calm, there's nothing unforeseen in terms of global events other than the continuing acceleration of climate change, for instance. What are we going to be talking about here in 5 years, would you say?
I think it's going to be the transition to renewable energy. I think that's been really expedited, and given where fossil fuel energy prices are now, I think that Europe has really doubled down on this. The world wants to be less reliant on oil and gas. So I think you're going to see, like I said to you, if I ask the audience here how many of you guys drive electric cars, the number of hands that will go up will probably be less than 10%, or maybe less than 20%. And I think that number is going to change drastically in the next 5 years. And the energy powering that and where that comes from is also going to transition significantly towards renewables.
Okay, thank you. If Elon Musk has his way, we'll be on our way to Mars anyway. Thank you, AJ.
Thank you for your time.